This is a lecture from Open Tuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
First of all, we're going to go through, following that introduction, we're going to go and look now at your equity settled share-based payments. Now remember, with your equity settled share-based payments, what we have there is the journal entry is that we debit the statement of profit or loss and we credit the equity. And when we're working the amounts to be shown in the financial statement, remember, we're looking at spreading the fair value over the vesting period based on the number of employees that we expect to exercise the option. And the key bit, isn't it, with regards to your equity settled, is that we take the fair value at which point? Excellent. Yeah, we take the fair value of the share option at the grant date, don't we? And we do not change it. So let's go through there and have a look at the first example. It says there, prepare extracts to be shown in the statement of profit or loss and the statement of financial position for each of the 3 years. So not just for 1 year. So is it there for the 3 years from December 2015 all the way, is it there, to December 2017? Okay, so 15, 16, 17 are 3 years. So when we're looking there at the extract from the financial statements, we need to go through there, don't we, and think about the statement of financial position and the statement of profit or loss. And we need to look at it there. Is it for the year ended 2015, 2016, and is it 2017? Okay. So 15, 16, 17. There we go. Okay. Excellent. And what we need to do as well, don't forget, is that within the statement of financial position, we're looking there, is it at equity, and then is it an expense through profit or loss? Okay, so if you get your pro forma set up, you're doing quite well. So what it says there is, it says Bree granted 10,000 equity settled share-based payments. So as soon as we know it's equity settled, we go through there and focus, don't we, upon the fair value at the grant date. Okay. We granted the share-based payments to the 20 directors. What we'll see in this example, to keep it simple, there is no change in the number of employees, so it sticks with the 20. The options vest on the 31st of December 2017. So 15, 16, 17 is a 3-year vesting period. None of the directors will leave, as we stated, over that period. And then you're given the fair value of the option. That's important. It's the fair value of the option. And you're given 4 figures there. Now remember, if it's your equity settled, we need to go through there and take the fair value, don't we, at the grant date. So even though I'm told what happens to the fair value of the option at December 15, I ignore it. December 16, I ignore it. December 17, I ignore it. Yeah, I use the fair value at the grant date, which is there as $12. Okay, so I apply that over the 3 years to the 10,000 options, and is it the 20 directors? So what we've got there, in the first year, to work out the figure on the statement of financial position, we've got there, is it 10,000 options, fair value of 12, 20 directors, and we are at the end of the first year of a 3-year vesting period, aren't we? So 10,000 times 12 times 20 divided by 3, that goes through there and gives me an equity figure of $800,000. In terms of what the expense is, the expense in this instance is going to be the same at 800,000 because we started off at 0 in terms of recognizing any expense and any equity balance at the start of the year, and it's now up to 800, isn't it? So we credit the equity with 800, and the other side of the entry is the debit for 800 as well. Okay. There's no change in the fair value in terms of the grant date, so we stick at 12. There's no change in the number of directors. So in the second year, it's still the same, 10,000. We still multiply by 12. We still multiply by 20. But at the end now of the second year of the 3. So remember, the SFP is a cumulative financial statement, isn't it? It shows you at a point in time. So we are at a point in time that is 2 years out of the 3. So 10,000 times 12 times 20 divided by 3 times by 2. We are now there, is it, I think, at 1.6 million. Okay, that's the equity figure that would appear within your other components of equity, if you like your shares to be issued in the future. Now, we've just got to be very, very careful in terms of the journal entries, because we are looking, aren't we, at the movement from 800 to 1.6 million. So to get from an 800,000 credit to a 1.6 million credit, we need to process another $800,000. So we've credited the equity and debited the expense with the 800,000. So when you're looking at what goes to profit or loss, it is the movement on the equity figure that goes to profit or loss, isn't it? Okay. Third and final year, not too much really to put in. I think you may already be ahead of the game as it is. But 10,000 times 12 times 20 is that 2.4 million, isn't it? So my equity balance is there at 2.4 million. Again, that's what the SFP figure needs to be. To get there, we need to process a journal entry that looks at the movement, isn't it? And the movement from 1.6 to 2.4 is another $800,000, isn't it? Okay. So remember, when you're looking at your statement of financial position, that's always at a particular date, isn't it? And the statement of profit or loss is for the year ended. So it looks at the story that's happened for each of those years, isn't it? On the SFP, it's all there cumulatively. Key bit that you've got within that question is that right the way throughout it, the expected number of directors did not change, did it? We granted the options to 20 directors, and those 20 directors were expected to stay for the next 3 years. In the next example, what we're going to go through and do is we're going to go through and look at a similar scenario, ever so slightly different numbers, but in that similar scenario, there are changes in the expected number of employees that are going to exercise the option. So here, again, similar requirements. It wants us to prepare extract from the statement of profit or loss from the statement of financial position for 2 years ended December 14, and is it there December 15? So it says here on the 1st of January 2014, EDAM granted 20,000 share options. So we are looking at equity settled share-based payments to each of its 10 directors. The conditions attached to the share option scheme is that the director must remain an employee of EDAM for 3 years. So again, we have a 3-year vesting period. And the fair value of each equity settled share-based payment at the grant date was $60. Okay. At December 2014, it is estimated that 4 directors would leave before the end of the 3 years. And then at December 2015, due to a downturn in the economy, it's now an estimate of 1. Okay, so therefore there is a change based upon the number of directors. So what we have there, once again, statement of financial position at a point in time, statement of profit or loss for the year ended, and I think it was there for 2014 and 2015. So remember, the key thing to work out is when you're looking at your equity settled share-based payments, is that on the SFP you have equity, and in profit or loss you have the expense, and the expense is equal to the movement, isn't it? I can't emphasize how important that actually is. Okay, so what have we got within that first year in terms of our calculations? We had, is it 20,000 share options, $60, 3 years, and 3 are going to leave. So 20,000 options, $60 fair value. 10 were there at the start, but you were expecting 3 to have left by the end of the 3 years. Again, we're at the end of the first of a 3-year vesting period. So yes, it was, careful, 4 directors. So let's just go through there and make sure that we don't make any daft mistakes there. So we have 20,000 multiplied by 60. 10 less 4 is 6, so multiply by 6. Divide by 3. Gives me equity, is it there, of 2.4 million. Again, in the first year of the scheme, the movement isn't too exciting because that is just exactly the same as what we have as the value of the equity, okay, because we've gone from 0 to 2.4 million. In the second year, 2015, we still have 20,000 options. Fair value is 60 still, that never changes. There were 10 directors there, but now we only estimate that 1 director will go through there and leave. We're on the SFP, so as at this point in time, we're at the end of the second of the 3 years. So multiply by 2/3. That should go through there and give you an equity figure of 7.2 million. If we're going through there and looking at the figure on the statement of profit or loss, remember that is the movement, isn't it? And the movement is there as 4.8 million. So in the second year, you're crediting the equity with 4.8 million and debiting the expense with the 4.8 million. There we go. So the focus upon that there is looking at the expected changes within the number of leavers that there are within that scheme. Here it specifically said we expect there to be 4 to have left by the end, and then specifically 1 to have left by the end in that example there. Okay, that's the tricky bit within any of these questions. It's always difficult, whatever the examiner gives you, to try and go through and interpret what you have with regards to the number of levers. Okay, that example may be a little bit too straightforward, but nonetheless, it's something to go through there and start thinking about. Okay, excellent.